How to build credit the right way for property, mortgage, and rental applications. Welcome to Short Let's Business, for your business and renovation tips and advice. Remember to subscribe. In property business, to build credit is something that must be done to enable one to get approved for a business loan, acquire a portfolio of properties, or pass a rental application credit check. So you will need a good rating unless you plan not to take out any loan, buy your properties using cash, or you plan to use your own houses as short-term rentals. To build your credit scores and report, you will need time. However, the earlier you check and tackle the problems which may be dragging down your credit score, the quicker your credit ratings will go up. You can increase your scores by simply taking a few measures, such as setting a direct debit to pay off bills on time and signing up with credit repair companies. What is a credit score? A credit rating is something that lenders use to measure your capacity to repay the loan lent to you. Credit comes in several shapes and forms. The most common comes in the form of credit cards, unsecured loans, automobile loans, and mortgages. Your credit score, a three-digit number used by lenders, is a tool used by the credit reference agencies to help them determine how likely it is they will be paid back on time if they give you credit. The higher your scores, the more likely you are to be eligible for business loans and credit cards, which will help you set up and scale your short-term rental business. What to avoid when building credit? To enable you to build credit, you must avoid doing some of the following: missed payments on account, using more money than you can repay, applying for credit frequently as your score reduces after every credit application, having a high credit use rate, which is how much of the available credit you have used, shutting an old account, deleting your credit file attached to it. How credit scores are calculated. With the different credit reference agencies and credit building companies, you will probably have different credit scores. That is because a credit score is calculated by applying a mathematical formula to your financial data by these companies. There is no one uniform algorithm utilized by all creditors or other financial organizations to calculate the scores. Most scoring models take into consideration your credit history on loans and credit cards, how much revolving credit you use, how long you have had accounts, the kinds of accounts you have got, and how many times you apply for credit. What Experian, FICO, Vantage, and Equifax look at. 1. Experian score looks at, runs from 0 to 999. How often you apply for credit. How much you owe. If you make payments on time. You will lose points if you have late payments and defaults. You will gain points if you consistently make payments on time. You will gain points if you are on the electoral roll. 2. FICO score looks at payment history, whether you have tried to build credit and paid your past credit accounts on time. Amounts owed, the entire quantity of loans and credit you are using compared to an overall credit limit called your usage rate. Length of credit history, the length of time you have had credit. New charge, how often you apply for and open new accounts. Credit combination, the number of credit products you have, such as credit cards, installment loans, finance company accounts, mortgage loans, and so on. 3. Vantage score looks at your payment history, your sort and period of charge and percentage of credit limit utilized, your balances, debts, your recent and credit behavior and inquiries. 4. Equifax score looks at your ability to pay your bills on time, every time, pay off your debts as quickly as you can, keep your credit card balance well below the limit. A higher balance compared to your credit limit may impact your credit score. Apply for credit sparingly. Applying for multiple credit accounts within a short time may impact your credit score. What is reported on your credit file? Your credit report provides a snapshot to potential creditors, landlords, and employers about the way you manage credit. For any loan, business or personal, or credit card you have had, your credit report records the following details: the lender's title, your payment history, account equilibrium, credit accounts, other revolving debt, what proportion of your credit you have used, electoral roll, all the addresses you have lived at, your credit association, the name of any person you have taken a joint account with. 3 important credit score factors explained. 1. Late payments and credit scores. If a credit card account becomes defaulted, or there is an array of overdue fees, these will negatively affect your credit score. If a borrower has failed to make payments for 3 to 6 months in a row, the lender generally applies a late payment fee, mentions it on the customer's credit file, and it will decrease the credit score. 2. Credit utilization ratio. Your credit usage ratio measures how far you are borrowing relative to how much you may borrow. Ratios are utilized to calculate credit scores, and creditors frequently rely on these in assessing your ability to settle a possible loan. Approximately 30% of your total credit score is dependent on your credit usage ratio. Most financial experts recommend a charge use rate of under 30 to 40%, and a few mention that individual balances should be as low as 10%. 3. Fixing credit report errors. Credit reports are tracked by the 3 big credit reporting agencies. Occasionally these agencies report false information because of a clerical error, incorrect information from credit lenders, as well as fraud. If there is an error on your credit report, you can use credit repair tools to dispute and correct it. You have the right to dispute any wrong entry on your credit file. The easiest way to dispute is by using credit repair tools. However, you can also speak to each credit reporting agency, or with the lender. How to build credit the right way. 1. Obtain a starter credit card. A starter credit card is intended for individuals new to credit taking, and do not have enough information on their credit file to be considered for higher loans. Starter credit cards frequently have reduced credit limits of $300 to $500, a yearly fee, higher rates of interest, and it can be given to people with limited or no wages. 2. Take a loan out using a co-signer. Another simple way to build credit for the very first time could be to start with a loan account using a co-signer who has great credit. A co-signer becomes necessary when the person applying for the loan does not have sufficient credit history, reliability, or income to get the loan on his own. A co-signer is thus guaranteeing the loan as they are someone with a good credit report, a stable income, and usually a family member or close friend. Cons of using a co-signer. If a person co-signs a loan for you and you do not make timely payments, your co-signer's credit will be impacted negatively together with your personal relationship with the person. In the event you default on the loan, meaning you stop paying, your co-signer is legally responsible to pay off the debt. This has destroyed plenty of relationships and you become a user on someone else's credit account. 3. Maintain a low use rate. When your accounts grow over time, your credit score will grow. Keep an eye on the usage rate of your credit, as this is one of the most significant elements affecting credit scores. To compute your usage rate, add up the total amount of your credit balance, and divide by the total credit limit. For example, let us say you have got 2 credit cards. Card 1, $2,000 balance with $4,000 credit limit. Card 2, $4,000 balance with $8,000 credit limit. Your whole balance will be $6,000 and your total credit limit $12,000. Your usage rate is thus 50%, which is high. Make sure you do not go over the 30% usage rate to enhance your credit score. The 4th way you can build credit is to apply for a credit builder loan. Some lenders provide loans to help you to build credit. These are little personal loans intended for people new to taking out loans. If you take a tiny personal loan and repay it in a timely manner, this can help to improve your credit score. Money management habits and mistakes to avoid. Some money management habits can undermine your attempts to build your credit, so it is important to understand what things to avoid. Listed below are 4 common errors. Not knowing how much you are able to spend on a credit card. Failing to have a budget. A personal budget is a must for all aspects of money management. Failing to shop around for loans. To pick a loan such as a mortgage or a car loan, you ought to shop around and compare to find the best. Failing to protect yourself from fraud. Credit card companies already take steps to decrease fraud, and national law protects users from several effects of fraud. But it is essential that you take action to protect yourself as well. Review your credit bills each month and track your credit report. Take good care of cards by simply carrying just the ones which you need in your pocket. Shred receipts and statements that have your account number on. In conclusion, to build credit, the credit scoring system will reward a customer's effort to regularly pay off or down their bills. A fantastic credit score is achieved by handling credit nicely, so until you can prove this, the credit reporting agencies will not have a way to state what sort of credit risk you will be. And finally, you will need to demonstrate you can handle a credit given to you.